Okay, so let's take a look at some examples here. Some concepts here that I haven't covered in the module, but they can only be covered in the examples because it's much better this way. Now we're looking at let's say this consolidation area right over here. We're looking at all this consolidation, we're looking at this rejection, and we have these clean candles here to the left hand side. Now we're trying to identify that what's the best way to execute a trade to grab this move that happened where price moved up. Now, first things first, we need to start reading the candles, and this is something very important as you're trying to read candles, because the beauty of hindsight analysis is that you'll be able to learn things which you couldn't have learned as you're looking at the charts, because now we're looking at hindsight analysis, which is great, and we're also going to try to learn a few things by reading candles. Now, first things first, we are creating a support, and obviously we should continue to move up. But the problem is we have this candle that formed a wick. So this means this candle rejected this resistance here to the left hand side. Okay, so we're going to keep that in mind. We rejected that resistance. The next candle, formed bullish like this, whatever. This one formed bearish. Now, if this one formed bearish for price to move down, this next candle should have broken below the low, but it didn't. So we closed bullish. Okay, awesome, no problem. The next candle closed bullish, but it also closed below these wicks here to the left hand side. Now we have the next candle, which was bearish. It went bullish. Now, remember this, at one point, this candle was bullish as well. Now, a lot of guys, what they're going to say is they're going to say, okay, you know what? As this candle is moving bullish, I'm going to take a buy once we break above this wick. But no, you remember the module we talked about? There's a wick over here. So you can't take an impulse entry as we break above the high, because this needs to be smaller at this point, right? This needs to be smaller at this point, and we have resistance here. So we don't know whether this candle will continue to push up or this candle will close with a rejection. That's something we just don't know. So what happened? The candle closed with a rejection, and the next we basically closed like this, like a small body bearish candle, like no volume to go down, whatever. So we're just waiting, because now at this point we're just consolidating now. You have the next candle that closed like this, like a doji, up down movement, doji, nothing's happening. Now you have the next candle that closed a very strong, solid bullish candle. So when you have a very strong, solid bullish candle like this, ask yourself a question: should I wait for an impulse entry, or should I take a buy as the next candle starts to open? That's something that you have to decide, because a lot of time what guys are going to say is, okay, you know what, yeah, I'm going to wait for this candle to wick down. Once we wick down and start to go up, then I'm going to take a buy, whatever, and things going to work out. No, as you're waiting for the candle to wick down, you have to understand this: when there's volume in the market, price can just continue to push up. If you look at the time, this is around 3:30, 4, 5, 6, 7. This is around Asian Open, so there's a lot of volume at this time. So that's the difference right over here, because as this candle closes, strong body bullish candle, you can look, it closed in this wick here to the left hand side, it closed into this wick, and it closed into this resistance here as well. Right now, sometimes traders may ask, okay, you know what? We're closing up at this resistance level. I don't want to take a buy, because I don't know what's going to happen at this point. That's the wrong approach. The best approach is you have to take a look at this and you have to ask yourself the question that what's the probability that the next candle will continue to push up versus what's the probability that the next candle would just dump down randomly? That's the question you need to ask yourself. Now, the next candle, it basically started to move up because we've broken above these areas. We have this confirmation that we're closing within these wicks, so there's a high probability for the next candle to continue pushing up. We have clean range here to the left hand side, and overall, just by reading price action at this point, this just made sense. Also, take a look at this. Before your Asian Open, there was no volume. We had consolidation. Candles are printing, side by side, right over here. There's nothing really going on. So the next candle, you have this confirmation. Next candle, let's say, even if you enter, let's say if this candle breaks above the high of the previous candle, that's still fine, that's still okay. But for example, let's say if this wick was big right over here, then waiting for an impulse entry over here, that would make no sense at all. Because now you're sacrificing these pips. You're sacrificing these pips. It makes no sense at all. Obviously stop loss is below the previous candle because we want it to make a higher high and a higher low, whatever, and then we can continue to push up. So for example, also, let's say, for example, let me clean this. Let's say, for example, you do take a buy right over here, and your stop loss is down at this point. If the next candle wicks down as you entered the position, as you enter the position right here, and next candle wicks down, that's totally fine. Let it wick down. Don't need to be scared. If you're getting scared, close 50%. If you're getting scared, close 50%. Because once it makes this wick down and start to break its own high again, now there's a higher probability for this candle to continue to push up. Because now you can say, okay, you know what? It's made a higher low because it has now broken its own high. You get it? It's made a higher low right over here, higher low or lower high, whatever. And now it's breaking its own high. So it has no business coming back down. It has no business breaking its own low again when it's already made a higher low. So it's made a higher low, and you can confidently say, okay, you know what I'm going to do? I'm now going to bring my stop loss from down here to up over here, and we can have a good move going up. Make sense? No, not make sense. Makes dollars. Makes dollars. Perfect. Let's take a look at the next one here. All right, let's take a look at this. Now, what do we have here? We have price dropping down. So when we take a look at this candle, right? This candle right over here. So we're only going to talk about the 30-minute time frame. So we look at this candle broke below this wick. Obviously there's no impulse entries because, as we talked about, this wick is too big. There's no impulse entry, right? There's also no entry as this candle started because we broke below the low. This candle closed with no wick, so obviously we've missed the trade, and this candle continued to move down. There are a lot of cowboys out there who will execute at this point, or who may look at the 15-minute or the 5-minute, whatever. But if you're a new trader, you have to calm the fuck down, and you need to just focus on, okay, I'm just going to calm down and I'm just going to wait for some sort of a better price action. That's it, right? So now you can see the candle bodies. Looking at candle bodies, the bodies of the candles are getting smaller and smaller. So whenever the bodies of the candles are getting smaller, this means the volume in that direction is decreasing. So when the volume in that direction is decreasing, this means the probability of price to go in the opposite direction, it increases. Now, one thing I want to point out in this scenario is, like, if we take a look at where this move started, we started at about 23.44, and we ended at around 23.33. So about like 100 pips, give or take, right? So this move was about 100 pips, give or take. Whenever there is a move that goes from 70 pips to 100 pips, I will look to see whether I can take a buy position in this scenario for price to retrace or not. Because if we're going to have a retracement, this retracement may be for like 40, 50 pips. If a retracement is going to be 40, 50 pips with confirmations, this means I can get 25 to 30 pips out of that move. If this move was, let's say, less than 50 pips, then I'd wait for price to come up, create some resistance, and then have price to go down so I can take a sell and trade the trend. If this was less than 50 pips. But if it's like, let's say, like 70 pips, 80 pips, 90 pips, 100 pips, whatever, I'm going to look for a scenario where I can take a possible buy position for price to move up. Now, what we see here now is we see the next candle that closed a very strong bullish candle with a wick on the top. Now we got a wick on the top. Now you got to ask yourself a question. Should I wait for the next candle to break above this high? Or should I execute a buy over here with lower risk? Okay, with lower risk, because this is a counter trend trade. Should I take a buy over here with stop loss below the previous candle, anticipating it to continue pushing up since we have this clean move happening over here? That's the question you need to ask yourself. If your answer is you're going to wait for an impulse entry, you probably didn't go through the you probably didn't go through the module previously that we posted, right? So over here, you're entering a buy as the candle starts, anticipating price to move up. The second thing you can do is, if you're not comfortable with this sort of counter trend, you could wait to see if we make this lower wick first. If price makes this lower wick first and breaks above the high or breaks above the starting point of the candle, then you can add the position having stop loss below this wick, right? Makes sense? So only looking at counter trends in this scenario if the move is about 70 pips, 80 pips, 100 pips, makes total sense. Let's move on to the next example here now. Let's take a look at this. Oh, this is already done. All right, so let's remove this. I actually did this already before, but we forgot to hit record. So now we're going to do it again. Okay, awesome. So in this case, what I want to point out is this move that we had. Now, before this move started, we were consolidating, or like, you know, this was all consolidation. We had this clean move that happened, price moved up. And let's say we came to the charts where you have a candle that's closing bullish like this. Now you have a candle closing bullish within this wick here to the left hand side. And now you're asking yourself, okay, if we're closing bullish, let me take a buy over here. So you're going to execute a buy. And as this candle breaks above the high, you're like thinking, okay, awesome. We can continue to push up because now we have a wick to fill here to the left hand side. And this could be a pretty good buying idea because, like, you know, we trended up, came down, we trended up, consolidated, and now we're breaking above this high for price to move up. But what happens? Price comes down and stops you out. What do you do at that point? Do you say, oh, Raja, what mistake I made over here? What did I do wrong? The question you ask when you ask, what did I do wrong? That's a question which means you are victimizing yourself. You didn't do anything wrong. You followed your rules, you followed the trend, you followed the analysis, you waited for your confirmation, you executed on the trade, and price came back down. Now, all these things that you did, they had a higher probability to go in your favor, and they had a lower probability to go against you. Whenever you're faced with a trade that has a lower probability to go against you, and it does go against you, there are two things you can do. Either you can take the full stop loss, or you can manage risk. If you take the full stop loss, you got to go over the risk management module. If you manage risk, you're totally fine, you're done. This was a winning trade at that point. You know, even if you manage risk and you take a loss, it's a winning trade because you lost less than what you planned on losing. Now, let's talk about this move that happened here where price pushed down. Now, in the beginning, you have the candle that's closing strong bearish, and you have this clean range here to the left hand side. As this candle starts to break this wick over here after making this top wick, because whenever price is going to break a zone, it will always, mostly always, it's going to make a liquidity wick because price needs to grab liquidity like a rocket ship and then continue to push down, or it needs to pull back first to push up like a what do you call a slingshot, like a slingshot, like, you know, like a slingshot. You pull back, you release it, and then it goes. So whenever you have price consolidating in a range, that's where mostly you will see candles make these liquidity wicks. These liquidity wicks indicate that as long as these wicks are not breaking the highs of the previous candles, this means they are making lower highs to break the lows to make lower lows, provided there's volume in the market and provided there's clean candles here to the left hand side. This is the beauty about hindsight analysis. We can do live technical analysis, we can do simulation analysis, but hindsight analysis is totally different, right? So we broke below the low, and your stop loss goes above the high of this current candle. If the stop loss is too big at this point, then you're looking at the 15-minute to see where I can place my stop loss. We've talked about that as well. If not, I think there's going to be a detailed webinar coming up in about a month and a half, so we're going to take a look at that. Right? So we broke below this consolidation, wicked up, we broke below the low, moved down, and then, like, you know, the next candle also moved down, but I guess there was some sort of a rejection. Let's take a look at the next one over here. Let's move on. All right, here we go. Now, this is a scenario where we had price trending down, and there were basically two things happening at the same time. So we're going to talk about one from a possible like a buying perspective, and then from a selling perspective. Now, we had candles move down, and we had some sort of a support form right over here, right? We have a support form at this point. Now, if you're looking for a sell, you're waiting for this candle to close, but the reason why it's not working, because candles are printing side by side. Look at this candle. This candle closed, no problem, indicating a possible reversal. The next candle closed right next to the previous candle. This candle, when it came down, it broke below these lows, but it moved too much. It moved too much, and it closed right over here. Now, once this candle is closed at this point, we don't know whether the next candle will retrace or what's going to happen, because, like, you know, there are two things. Either you're entering a sell as we're breaking the low, something we talked about in the previous example, and you're having the stop loss maybe up over here, or I would say maybe within the range, because if we are breaking below these lows and you're having the stop loss within the range, this means that we're breaking the lows to make lower lows, then the candle has no business coming back in the range. It has no business retracing back in the range, because if it does retrace back in the range, then you can just manage risk. You know, that's what you can do. You can just manage risk. Anyway, so let's say you did not take the impulse entry and you're waiting for the candle to close. The candle closes with a big bearish candle, and the next candle closes like this. You're like, okay, perfect, awesome. We have closed like this, and now I just want to see some sort of a retest. Now, there are two types of traders at this point. When we're looking at this in hindsight analysis, there are two types of traders. Number one, who are waiting for price to retrace. Let's say this is the retracement. Come up, candle body gets smaller. You're not doing anything. This candle starts to break above the high. Do you take a buy or no? Do you take a buy? Yes? You're a dumbass if you take a buy over here. You don't take a buy, because we've already moved so much on these candles. So you wait, we wait, and the candle forms with like a rejection bearish candle at this point. We formed a rejection candle. Look at this candle's body compared to the previous candle's body. This body is way bigger than the previous candle's body. As the body is bigger, now you know that, okay, we have this clean range here through the left-hand side. What's the probability that the next candle will continue to push down? There's a high probability. So now there are two things you can do. You can enter a sell as this candle starts, have the stop loss above the previous candle. Now, obviously, this is going to be a big stop loss, so what about your lot size? Your lot size is going to be smaller at this time because it's a big stop loss. Your lot size is going to be smaller. So that's one thing you can do. The second thing you can do is, this is risky because you might miss the trade. The second thing you can do is, you can enter, dynamic risk. You can enter dynamic risk, which means, obviously you know what this means because you've gone over the risk management modules. You enter dynamic risk, saying that, okay, I'm going to enter dynamic risk, and if price retraces, I'm going to have my stop loss right up over here. When we do a retrace, and when after the retracement, we start to come down, let's say 3/4 of the way, I'm going to enter another position. Stop loss goes up over here, and as it starts to break its own entry area, or as it starts to break its own open price, you can have your stop loss above this wick, then bring this stop loss down over here as well. We have clean candles, then we can push down. But also what's important is to secure positions. Never let price go down to the full potential TP, because this is a mistake a lot of guys make, is that they will have their TPs at the end of the zones and price will never reach that zone sometimes. So if you look at this, if you entered here, this price was 23.27, and where we closed was, let's say, 23.50. So this is about like a 35-40 pip move. It's more than enough, man. 35-40 pip move if you're waiting for a price to form resistance, you enter here and price moves down. This is an excellent scenario. Now, let's talk about the other traders who I call cowboys. And what these cowboys do, they don't wait for confirmations. They execute on impulse entries. Now, impulse entry here is perfect. Price came down. We formed a candle like this. And this is something that you understand with experience. The more you look at the charts, the more you read candles, the more you look at the moves, the more you understand that, okay, like, you know what, this actually made sense. And let me explain it. Now, some people are watching this and they can read my mind and they know exactly what I'm about to talk about, right? Once this candle starts to break the high of this previous candle, this is a great example of an impulse entry where now you're saying that, okay, if I take an impulse entry here, have my stop loss below this current candle, because if we're breaking above this high, this means we can create a higher high, because now we have this clean candle here to the left hand side. If we measure this range, you know, this range is, let's say, in the middle, like, what's this? 23, 60, 50. And if you're entering right over here, this is 23, 23. Like about like a 35 pip range. You got a 35 pip range, you're taking a buy at this point, you're grabbing like 20, 25 pips, 20 to 25 pips out of this. You know, and this is something you truly understand once you watch charts, once you miss charts, you go back to your chart and you see that, okay, I missed this trade. How could I have given it another chance? How could I have been a part of this trade? I missed it. You know, these are some things that you understand and you learn with experience as you watch the charts, right? So, hope this was helpful. I tried to go in as much detail as possible, but these scenarios, they do happen over and over and over again, which is why it's very important to keep an eye on these scenarios. It's very important whenever you end the day, your trading day, whatever, you go over your wins, how you could have had a better entry. You go over your losses to see how you could have had, like, you know, better risk management, how you could have lost less than what you've lost, because that's going to really propel you in the correct direction when it comes towards trading, and obviously when it comes towards making money while you're trying to trade. So hopefully this helps. Take care, everyone. We'll see you next time.